Here is the detailed stock analysis script for Nuburu, ticker symbol BURU. Right now, as we watch the live markets, Nuburu stock, ticker symbol BURU, is trading at approximately $0.2467. The stock is currently down roughly 5.3% on the intraday session, showing the kind of intense volatility that keeps traders glued to their screens. We are seeing volume already pushing past 2.5 million shares, indicating that despite the microcap status, eyes are very much fixed on this ticker. If you're looking at your screen right now, you are seeing a chart that is struggling to find a floor after some significant recent swings. The market is reacting in real time to a complex mix of technical breakdown and fundamental confusion. And if you are holding positions or watching from the sidelines, you need to understand exactly what is driving this price action today. Most investors look at a chart like BURU's and see a simple penny stock story. A company that came public, saw its value erode, and is now fighting for survival near the 25-cent mark. The expectation here is that this is just another distressed industrial company running out of runway, likely to fade into obscurity or face another reverse split just to stay listed on the NYSE American Exchange. That is the surface-level narrative, and frankly, it is what 90% of the market believes. But the reality is far more nuanced, and quite honestly, much stranger. What you are actually looking at is a company attempting a radical, high-speed metamorphosis from a pure-play industrial laser manufacturer into a diversified defense technology platform. The disconnect between that ambitious internal pivot and the brutal external reality of their balance sheet is what is creating this violent volatility. If the reality of their defense integration succeeds, the current pricing is a massive miscalculation. If it fails, the bears are entirely correct. To understand why this is happening, we have to look past the ticker price and look at the technology itself, because that is where the original value proposition lives. Nuburu is not just making generic lasers, they specialize in blue laser technology. This is critical to understand because it fundamentally differs from the infrared lasers that have dominated manufacturing for decades. Conventional infrared lasers are excellent for cutting steel, but they are terrible at processing reflective metals like copper and aluminum. When you shine an infrared beam on copper, the metal reflects a huge portion of the energy and heat away, making the welding process inefficient and often defective. Nuburu's blue lasers operate at a different wavelength, specifically 450 nanometers, which copper absorbs roughly 13 times better than infrared light. This is physics, not marketing. This high absorption allows for spatter-free welding and faster processing speeds, which is exactly what is needed for the electrification of the global economy. Think about the copper wiring in an electric vehicle battery or the delicate components in consumer electronics. The expectation was that this blue laser advantage would immediately translate into massive revenue growth as the EV sector exploded. Investors looked at the rise of Tesla stock and assumed that any company supplying the underlying manufacturing tech for batteries would ride that same wave. However, the reality has been slower adoption and high capital intensity. Manufacturing giants are slow to switch out their expensive legacy equipment for new blue laser systems, even if the physics are superior. This delay in mass adoption has burned through Nuburu's cash reserves, leading us to the precarious financial position we see today. The market expected a steep ramp-up in sales that simply hasn't materialized fast enough to cover the burn rate, and that disappointment is priced directly into that 24-cent figure you see on your screen. But here's where the story pivots, and this is the insight that most casual observers are missing. Management realized that waiting for the industrial manufacturing cycle to turn was bleeding them dry, so they initiated a strategic shift toward the defense sector. This is why you might have seen recent headlines about acquisitions that seem unrelated to lasers. For example, their move to acquire Orbit, an Italian company, and their partnership with Tekne. This is not just about welding copper anymore. This is about applying their high brightness technology to military applications, such as drone defense, optical dazzlers to confuse enemy sensors, and advanced communication systems. The defense sector spends differently than the commercial sector. Contracts are stickier, often government-backed, and can provide the kind of steady cash flow that a volatile commercial market cannot. When you log in to your Schwab Intelligent Portfolios or check your account on Fidelity, you are often presented with sector-based opportunities. Usually, you have to choose between industrials and defense. Nuburu is trying to force its way into both. They're pitching a narrative where they use their core IP, the high-power blue laser, to secure defense contracts that pay for the R&D and operations, effectively subsidizing the commercial side of the business until the EV market matures. It's a classic bridge strategy. The risk, of course, is execution. Mergers and acquisitions are difficult, even for well-capitalized companies with armies of bankers. For a microcap company with limited cash, acquiring European entities and integrating them into a cohesive US-based defense platform is an incredibly heavy lift. This operational risk is why the stock didn't skyrocket on the news of the acquisitions. The market is waiting to see if they can actually close these deals and generate revenue from them, or if these are just paper announcements that will fall apart. Let's talk about the trading dynamics we're seeing today. The volume on BURU has been elevated recently, often trading tens of millions of shares in a single session. This high turnover is characteristic of a battleground stock, where retail traders and algorithmic high-frequency traders are clashing. If you use Robinhood stock trading or the Webull app, you have likely seen this ticker pop up on most active or top loser lists. This visibility brings in momentum traders who care very little about the blue laser physics and very much about the half-cent scalp they can make in 30 seconds. This creates a disconnect between the stock price and the fundamental value. The stock might drop 10% because a large financing deal was announced, diluting shareholders, or it might pop 15% because a short position got squeezed. Right now, the downward pressure is largely due to concerns over financing. To keep the lights on and fund these defense acquisitions, Nuburu needs capital. In the world of microcaps, capital almost always comes at the expense of existing shareholders through dilution. We need to address the elephant in the room: compliance. Nuburu has faced multiple warnings from the NYSE regarding its listing standards, specifically its low share price and stockholders' equity. This is a common pattern for companies in this phase. They often have to resort to reverse stock splits to get the share price back above the $1 minimum requirement. A reverse split is purely cosmetic. It doesn't change the market cap, but it often acts as a negative psychological signal to the market. It tells investors, we couldn't get the price up on merit, so we're doing it mechanically. If you are holding BURU in your SoFi Active Investing account or your Vanguard IRA, a reverse split can sometimes result in reorganization fees or simply a jarring change in your share count. It's a risk factor that must be factored into any long-term thesis here. The company is fighting to regain compliance organically, but the clock is always ticking in these situations. This brings us back to the technology. Why stick around? Why not just sell and buy NVIDIA stock or something safer? The argument for holding, the reality that exceeds expectations, is that the intellectual property portfolio is genuine. They have roughly 200 granted and pending patents. In a world where intellectual property is often the most valuable asset a company owns, Nuburu's stranglehold on high-power blue laser IP is significant. Even if the company struggles operationally, that IP has value to a larger player. Imagine a major industrial conglomerate that wants to dominate the next generation of 3D printing or aerospace manufacturing. Buying Nuburu for its patent portfolio could be a drop in the bucket for them. So there's a floor to the value here, theoretically, provided by the technology itself. This potential for a buyout or a strategic asset sale provides a strange kind of safety net, albeit a risky one. Let's pause for a second. I want to hear from you guys. Comment below how many shares of Nuburu you currently hold and what your average cost basis is. Are you holding for the blue laser tech, or are you betting on this defense pivot? I'm genuinely curious to see where the sentiment is right now among retail investors. Moving back to the analysis, we have to look at the macroeconomic environment. We are in a period of relatively high interest rates compared to the last decade. This hurts growth stocks, but it absolutely crushes microcap stocks that rely on debt or equity financing. When money is expensive, investors are less willing to fund science projects that might be profitable in 5 years. They want cash flow now. This is why the defense pivot is so crucial. Defense contracts are one of the few areas where long-term development funding is still readily available. Governments don't stop spending on defense just because interest rates are up. If Nuburu can successfully reclassify itself as a defense contractor in the eyes of the market, it might earn a higher valuation multiple and gain access to more patient capital. It's a race in time. Can they secure that defense label before the industrial label drag them under?